You know, it's crazy to think about, but the 2008 financial crisis was the most severe shock to hit the global economy in over 70 years. So today, we're diving into this explainer to really demystify that catastrophic collapse. We'll look at the massive government interventions that followed and the complex regulations designed to make sure history doesn't repeat itself. Because let's face it, the aftershocks of '08 are still totally shaping how we handle money, banking, and government policy today.
So here's our agenda for today. We're going to start with the 2008 market collapse itself. Then we'll look at stopping the bleeding with TARP, followed by China's massive economic stimulus. Finally, we'll wrap up with the preventative medicine, U.S. reforms under the Dodd-Frank Act, and global defense through Basel III.
All right, part one, the 2008 market collapse, when the bubble burst. Let's look at the catalyst that brought the entire global economy to its knees.
We often think of economic downturns as these slow, gradual declines, right? But the fall of 2008, it was a sheer cliff. The contagion spread across the map in just a matter of weeks, completely destroying investor confidence globally. Just look at this timeline. Following the Lehman Brothers bankruptcy in September, the Indonesian stock market literally had to halt trading. The IMF is out there warning of a systemic meltdown, and Iceland's market essentially collapsed, reopening 77% lower. The panic wasn't just immediate, it was absolutely everywhere. But the true devastation was really the visceral, human scale of this shock. U.S. household wealth plummeted by an unfathomable $11 trillion as the subprime mortgage crisis infected the real economy. $11 trillion. We're not just talking about red numbers on a trading screen here. This represented lost retirements, foreclosed homes, and evictions. Between the peak in 2007 and early 2009, this sudden evaporation of wealth caused consumer spending and business investment to just hit a brick wall, dragging the whole world right into the Great Recession.
Now, you might be wondering, what made this crash so much worse than past recessions? Well, the sell-off was fueled by some distinctly new factors. Unlike previous downturns, we saw the widespread use of incredibly complex, opaque financial instruments. Banks were trading these mortgage-backed securities that were so convoluted, honestly, almost nobody truly understood the underlying risk. Add to that a sharp acceleration in leverage, meaning institutions were borrowing heavily to make these bets, and the fact that this all rested on the shoulders of everyday households with subprime mortgages. When people couldn't pay their mortgages, this highly interconnected, highly leveraged global house of cards simply collapsed. Which brings us to part two, stopping the bleeding, TARP. With the financial system basically seizing up, emergency interventions were required immediately, leading to massive U.S. government action. What's really fascinating about the Troubled Asset Relief Program, or TARP, is how dramatically it shifted its strategy mid-crisis. Originally, the Treasury wanted to use $700 billion to buy up toxic assets, those bad mortgage-backed securities. But the situation was deteriorating so incredibly fast that they had to pivot. Instead, they directly injected capital into financial institutions by purchasing their preferred stock. It was definitely a much faster fix, but it also meant the government was directly bailing out Wall Street.
Now, at the time, this was one of the most intensely unpopular pieces of legislation in American history. People were absolutely furious that the banks that caused the crisis were being saved by taxpayers, and there are massive fears of a blank check. But if we look purely at the math of the program, it's a slightly different story. By 2014, as companies bought back their stock and paid dividends, the Treasury actually recouped $441 billion on the $426 billion disbursed. So they ended up netting a $15 billion profit.
Moving on to part three, China's massive economic stimulus. Because while the U.S. was bailing out Wall Street, China was facing its own severe crisis. You see, global demand for Chinese exports had just collapsed, threatening tens of millions of jobs. So China responded with a 4 trillion RMB stimulus plan. To put that into perspective, that was equivalent to a staggering 12.5% of their 2008 GDP. This was a fiscal expansion that vastly exceeded Western programs in relative terms. Because they relied so heavily on manufacturing and exporting, when global orders stopped overnight, the Chinese government opened the fiscal floodgates at an unprecedented scale to prevent massive unemployment. And if we look at where that money actually went, it's pretty incredible. A massive 1.5 trillion RMB went straight into heavy investment for physical infrastructure like railways. And another 1 trillion went to post-disaster reconstruction for areas devastated by the Wenshan earthquake. They weren't bailing out financial engineers over there. They were literally pouring concrete and laying steel to artificially replace all that missing global demand and keep migrant workers employed. So, looking at the long-term side effects builds this really fascinating contrast between the Eastern and Western emergency responses. Both sides definitely succeeded in their immediate goals, right? The US avoided a total financial collapse, and China managed to keep its GDP growth rate above 9%. But the hangover was severe for both. The US was left with deep public anger and this lasting moral hazard, the idea that banks might take huge risks again knowing the government will just save them. China, on the flip side, funded a lot of their stimulus through local governments. This fueled a massive surge in local government debt, overcapacity, and a lot of highly inefficient infrastructure spending.
Okay, let's move to part 4, U.S. reforms, the Dodd-Frank Act. Once the immediate fires were out, lawmakers basically had to completely rewrite the fire codes. This sweeping 2010 reform specifically targeted the whole too-big-to-fail dilemma. Dodd-Frank designated these massive interconnected entities as SIFIs, or systemically important financial institutions. The idea here is actually pretty simple. If a bank is so large that its failure could take down the entire U.S. economy, it needs special rules and intense Federal Reserve oversight. They actually required these banks to draft living wills, basically a legal roadmap of exactly how they can be safely dismantled and liquidated in a crisis without relying on another taxpayer bailout.
These new pillars fundamentally shifted U.S. regulation from a micro-level focus to a big-picture macro-prudential view. We got the CFPB to watch out for predatory lending, which, as we know, sparked the whole subprime mess to begin with. We got the Volcker Rule, banning banks from using depositors' money for highly speculative proprietary trading. And crucially, it mandated central clearing for over-the-counter derivatives. So those complex, opaque instruments that brought down Lehman Brothers, they now have to be traded in the open.
Finally, part 5, Global Defense Basel III. Because this crisis was truly global, the regulatory response required a massive international consensus. To really understand the Basel III framework, we need to look at the exact mechanism that causes banks to fail in the first place: maturity transformation. It is the absolute bread and butter of banking. Think about it. You deposit your paycheck, which is short-term borrowing for the bank because you can withdraw it tomorrow. The bank then takes that money and lends it to someone buying a house for 30 years, which is long-term. It's profitable, but inherently fragile. Because if everyone gets scared and asks for their deposits back on the exact same day, the bank just doesn't have the cash. That's a classic bank run. And in 2008, it brought the global system to its knees. So Basel III's answer wasn't just to ask for more capital. It actually forced banks to hold enough highly liquid cash to survive a 30-day panic without government help. Before the crisis, global rules focused almost entirely on capital adequacy. Basically, do you have enough overall value? But as we learned the hard way, you can be highly valued and still completely run out of cash. The post-crisis rules introduced the liquidity coverage ratio. It acts like a massive emergency fund, requiring banks to keep a stockpile of high-quality liquid assets so they can survive a 30-day acute stress scenario on their own. This comprehensive document provided the regulatory foundation for a resilient global banking system, and it fundamentally changed the math of banking. It was a highly coordinated global effort that forced banks to hold significantly more of their own skin in the game, meaning they had to increase their common equity Tier 1 capital to absorb losses. It also introduced countercyclical buffers. That just means banks are now forced to save more capital during economic boom times, ensuring they have a sturdy cushion when the cycle inevitably busts. So, we've explored the collapse, the massive stimulus interventions, and the new regulatory architecture. But with global debt rising and totally new financial complexities emerging every day, we really must ask, are these financial firewalls strong enough for the next crisis? We've patched the holes that sank the ship back in 2008, ensuring better liquidity, higher capital standards, and mechanisms to let big banks fail safely. But financial markets are incredibly innovative, constantly moving risk into new, unregulated shadows. Will Dodd-Frank and Basel III actually be enough when the next unpredictable shock hits? Well, that is the multi-trillion-dollar question.